Hello everyone, this is Tyler from Macro Ops presenting this week's Market SitRep entitled Max Dissonance. Let's get into it. So we got two topics here today that we want to cover: the risk on, risk off phenomenon, and then equity valuations, long-term equity valuations. So you're seeing this very weird phenomenon in the market where we have risk on assets rallying and risk off assets rallying. And this makes it for a real tough read about what's going on and what the actors are thinking here. So I'll demonstrate what I mean by this risk on, risk off phenomenon. Now, we entitled this presentation Max Dissonance because when we get this risk on, risk off phenomenon, it means that the price action and the underlying long-term fundamentals strongly disagree. So you'll see in a second here how this conflicting signals absolutely litter the marketplace. Here we go. We got SPX, S&P 500, rallying hard from the Feb lows. That's a risk on movement. And risk off. Look at this. This is Japanese yen strengthening. When USD JPY goes down, it's a strengthening action. It's considered risk off. Yen is a safe haven currency. So when people are fearful, they flow into the yen. When people are risk on mode, they typically sell yen because it's cheap, and they use it to fund in risk-on assets, stuff that's will get them a yield. And you can see 2013, 2014, this big rip we had, that's exactly what people were doing in the carry trade. They were selling yen at cheap prices, and they were funding risky assets. But now it's just a different story. We have the market ripping, but yen strengthening. We have risk-on with junk rallying hard from the lows, a V-bottom. And we have risk-off. We have 30-year treasury bonds rallying near all-time highs. So this is very rare to see. You have speculative junk debt rallying and you have U.S. treasuries rallying. Typically, U.S. treasuries are a place where funds go when stuff's not looking good, when they're scared. But we see them putting money into junk and 30-year at the same damn time. Risk on, XLK, the technology ETF, near all-time highs. And the tech sector is a high growth sector. It's a speculative sector. It's a place that we, as investors, feel that is a risk on type of sector. And risk off, utilities rallying. So can you believe this? You got the tech sector rallying. You also got utilities rallying at all-time highs. This is typically a defensive play. When funds feel like there's not a lot left in the cycle, they go to XLU because utilities are a defensive play and they typically don't get hit as hard in a bear market. So what is the market telling us now? We also have seen it in the commodity space, right? Risk on with crude oil futures rallying here. And also risk off. Gold rallying too. So what is it? Which one is it? Who's right in this situation? Well, someone is right and someone is wrong. And one of these groups is going to collapse and one of them will win out. But you can see here why we're at a max dissonance point. So the way we can explain this type of action here is through the Lynchpin. And if you've been watching these market sit reps, we talk all the time how the USD, United States dollar, is the linchpin of this market. So we think all these moves are upward due to USD weakness. And that's simply because the USD is the numeraire. Everything is valued in USD. So when USD is the linchpin and it's been selling off to the bottom of its range, everything priced in it rallies short term. And that's why it's called the numeraire. So treasury bonds are priced in USD, crude in USD, gold in USD, stocks in USD. Everything is priced in USD. And so these movements in the dollar can have a strong impact on the market. And here's a good graph showing the relationship between dollar and oil. And you can see how close it correlates, especially in times of volatility and distress, like in the 2008 time period, and also now recently. The bottom subgraph is the correlation coefficient. We're back at 1.0. So oil is tracking the dollar perfectly. And so all these assets are rallying on the Fed dove-talking the dollar down. And the world continues to push the easing agenda in the face of stagnant growth. And we're left with mixed signals. Just everything rallying. And again, that's why we're back to this max dissonance point. There's extreme dissonance between price action and the fundamentals. And it's just very, very hard long-term to position here. I mean, if you want to take strategic positioning in the market, what are you going to do? I mean, there's no clear signaling out here. You can't short because you'll get your face ripped off. So really the only answer right now is to do some short-term tactical trading, some swing trading. That's the only thing you can do in this environment, and that's what we're doing in our tactical account. But for long-term strategic positioning, where are you going to go? Investment managers, they see this too in the professional space. They're not dumb, and they have to chase their yield and returns because if they don't, they're fired. So it's all short-term money chasing the hottest theme. And it's unfortunate, but fund management these days is so focused on the short term. You know, if I go out and raise a bunch of money and I have funds set up and I'm just sitting in cash, investors aren't going to like that because they're paying me fees to make them money, not sit in cash, even though that could be the right thing to do for the next year or so. So they're forced to do short-term money chasing. And is there long-term value here? Absolutely not. And you'll see in this next section why there's no long-term value. And that's because equity valuations at these levels are insane. So in the big picture, the Fed can talk the dollar down, right? We can get some short-term relief in energy and junk debt, but the easing doesn't make stock valuations any cheaper. It just doesn't. We make everyone feel happy for a nice little rally. Maybe banks get a little bump. Those guys can be a little happy and go to the Hamptons this summer and not have to worry about a disaster. But that's about all we get. It's all short term. So you get a good summer vacation, but that's about it. And look at this graph. This is market cap to GDP by Hussman Strategic Advisors. Buffett loves this indicator. And Hussman makes a very compelling case here. So if you see the blue line, that's the market capitalization of non-financial equities over nominal GDP. And then the red line is the actual subsequent S&P 500 nominal annual total return over following 12 years. Look how close that tracks each other. Okay? And so what this chart is saying to us right now, and you can see in the far right area, that given the market cap of the current market to our nominal GDP, expected returns are 2% in the next 12 years. Okay, so that means if you buy equities here, the best you're going to get is 2% a year for the next 12 years. And we're not talking 3, we're not talking 5 years, we're talking the next 12 years. Okay, how different is our lives going to be in 12 years? Can we afford to sit in a place like equities and earn only 2%? No. So equities long-term basis are just unviable at these levels. Another graph, market cap to GDP, this time market cap measured by the Wilshire 5000. All-time highs. That graph is at all-time freaking highs, above 99, mind you. So if you think stuff's a good long-term buy here, you're just completely out of your mind. There's no easy way out unless an aggressive growth spurt kicks in. They're just so highly valued here. The only way you can justify these valuations is if they really pick up growth and we get that denominator aggressively going up. And that looks very unlikely given the growth rates we're seeing in EPS. I mean, just check it out. So on the far right there, you can see the estimates for Q1 2016 earnings. Horrible. And we've had downtrending EPS growth since all of last year. And that's why the market has been in a range, going nowhere. You made no money in equities since the end of 2014, even at these levels up here. At the beginning of the year, you hadn't made money in equities since 2013. So that denominator, that GDP number, is not going to skyrocket and lower that ratio anytime soon. And to make matters worse, the cost of money is going to rise. And when it does, corporates are going to be more squeezed. Their profit margins are going to be taking a hit, and we will see equities trade the other way. Now, this cost of money is going to rise in one of two ways. It's the inflation scenario or the deflation scenario. And when this happens, the picture flips very, very quickly. So in the inflation scenario, we have if the CPI continues to rise, the Fed's hand will be absolutely forced to save face and credibility, and they'll be forced to raise rates. Even if they don't do that and inflation expectations pick up, which you're sort of seeing in the gold market right now. Now, if that maintains that consensus in the market, you're going to start to see the long end rally. Those rates are going to start to rally. And If that doesn't happen, commercial banks are going to have to raise the rates on their loans that they give to businesses and consumers just to stay in business, because their net interest margin is getting squeezed hard by this lower for longer scenario, and they're hurting. And that's why banks have sold off so much this year. Their business is hurting. So they're gonna need to save themselves and raise rates to make a little bit of profit and stay in business. So when this plays out and rates increase, the cost of money goes up, and this squeezes corporates who are already nearing the end of a cyclical peak. In the deflation scenario, the lower for longer scenario, where we just keep rates so low forever and we start to actually get deflation printing, the real cost of debt goes up and corporates are still in a profit margin bind. So when we have deflation, that actually benefits the creditors because they're getting paid back in stronger dollars. The debtors want a slight inflation scenario because they get to pay back their debt in weaker dollars. And here's a nice demonstration of the squeeze going on in corporate profit margins. You can see this is a very good mean reverting indicator. We've been uptrending slightly since mid-90s, but it's starting to turn over now. And when that turns over, let me tell you something, the equity market doesn't return well. And a lot of people would point me to this graph and say, look, take energy out, it's not that bad. And the dark blue line is without energy, so you can see most of the profit margins have been getting killed by the energy patch. But we just don't buy that. Why? Because the business cycle is long in the tooth. And at the end of a business cycle, labor costs rise because low employment means labor has more negotiation power. This is what happens every single time at the end of a business cycle. So costs go up for corporates, profit margins decrease, and then you got to add in cost of money going up. So your leverage costs more and your expenses cost more. And then you got market cap to GDP at all-time highs. This is a perfect storm for falling equity prices in the next year or so. And don't forget about the dollar, okay? Just because the dollar has been weakening now doesn't mean it will continue to weaken, all right? Europe and Japan are so damn weak. Their economies are suffering more than the U.S., significantly more than the U.S. They have poor inflation. They have poor output. And they will intervene, okay? If they see that their economies can't get up and they risk a collapse, they are going to intervene in their markets and they're going to force their currencies to weaken against the USD. And then the USD Lynchpin will resume its rally as well. And when it does, it's going to put even more pressure on U.S. corporate profits and margins. It's harder for them to sell goods overseas. So what's the takeaway? We are left right now with a very fragile system with very little upside. Short-term tactical trading is fine if you can get it in and out quick. Not everyone can do that. It's not for everyone. But that's really the only play here because it's hard to strategically put long-term money at work because of the high level of dissonance. All right, and the price action is making it very, very tough to sit into trades because shorts get their face ripped off, and then longs, they just don't have much upside long-term. So it's very much a sidelines market. So it's great to be in cash right now, waiting for things to get murdered, like we saw in the energy sector, so you can scoop up and buy things for pennies on the dollar with dry powder. And if you look at all the smart big boys like Seth Klarman, KKR, etc., they're raising cash right now to go in and buy distressed debt, distressed companies when this cycle turns. Okay, because that's going to be where the money is made. When this cycle turns and you have dry powder to buy up equities again and assets at very cheap valuations. So there will be great buys in the future for those that are patient enough. And before we go here, I just want to look at this graph again from Hussman Strategic Advisors. You can see here, tops are always volatile. So when you get these huge base ripping rallies and these big down moves, that's kind of normal at a market top, all right? Look what happened 72 to 74, 99 to 2002, 07 to 09. You get a lot of volatility, shake everyone out, and finally the trend resolves. So don't think that the possibility of a downtrend is over. It might be stalled a little bit and pushed back in time. You know, we're probably going to be chopping up here at highs for a little bit more, but the downside movement is still in play. Thanks for listening, guys. Once again, this is Tyler with Macro Ops presenting this week's Market SitRep. If you like us, subscribe to the YouTube channel, follow us on StockTwits, Twitter, visit our website at macro-ops.com, and also join our Facebook group. It's a free group, and we're having a lot of fun in there. We have people all around the world now commenting, discussing, learning stuff, finding cool marketplace to do, making money. It's a fun time. Hop in there, and I'll see you guys next time.